Hello everyone. Today we're going to talk about the FOMC statement overnight, then give you a brief market update, and discuss today's Bank of England decision. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment. The FOMC statement hinted at a rate hike in December with one new word. The key change was in the sentence, "The committee judges that the case for an increase in the federal funds rate has continued to strengthen, but decided, for the time being, to wait for some further evidence of continued progress towards its objectives." Now, this sentence was exactly the same as in September, except for the addition of the word some. That indicates even less evidence is needed than in September. For example, the two non-farm payroll figures between now and the December meeting could be enough. The odds of a December rate hike jumped to 78% from 68% the day before. Nonetheless, the dollar weakened anyway on fears about the U.S. presidential election. It was a typical risk-off move. Stocks were down for the 7th consecutive day, only the third time in the last 10 years that that's happened. The Mexican peso weakened, and the safe havens yen and gold rose. Well, for today, the focus will be squarely on Britain and sterling, as the only major economic indicators during the European morning, the UK service sector PMI, is followed by two big events for sterling. First, the UK High Court will rule on whether the government has the right to pull out of the EU without consulting Parliament. If the decision goes against the government, then Parliament might get the opportunity to reverse the Brexit decision. Sterling would be likely to rally hard. Then comes the last of this week's four major central bank meetings, the Bank of England Monetary Policy Committee, MPC. Now, following the resilient Purchasing Managers Indices, PMIs for Britain, and the surprisingly strong third quarter GDP figure, plus the continued weakening of the currency, the market expects the Bank of England to keep rates on hold at this meeting. In fact, rates are expected to be on hold for the foreseeable future, as you can see from the graph, where the yellow line indicates rates are expected to be unchanged for at least the next year. Now, if the MPC does keep rates on hold, as everyone expects, then the focus will be on the bank's new economic forecasts. These may show inflation rising even further above the target than previously because of the fall in sterling. The question is whether they'll tolerate this above-target inflation because of the weak currency. So far, comments from MPC members have been mixed. On the one hand, they said they're willing to look through an overshoot. But when pressed on the issue, Governor Carney said there were limits to their tolerance. The key is probably in the new growth forecast. If growth is revised up following the better-than-expected data, then the bank will be less willing to tolerate an inflation overshoot and sterling should strengthen. On the other hand, if they revise growth down, then they'll probably want to cushion the blow with low rates and sterling is likely to weaken. I think, given the UK economy's performance so far, they're more likely to go with the former, to revise growth up, and sterling is likely to strengthen following the release of the report. For an update on the U.S. indicators coming out today, please watch my North American opening market comment. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.